All right, let's talk about something you've probably heard thrown around a lot in finance: beta. In this explainer, we're going to pull back the curtain on this key metric. We'll break down what it is, how you can read it, and most importantly, how you can use it to get a better handle on investment risk. You know how it is. The stock market feels like a total roller coaster, right? Some days it's up, some days it's down. But have you ever noticed that some stocks seem to dance to their own beat? The market will be having a good day, and one stock just skyrockets. Or the market takes a dive, and another barely flinches. Well, there's actually a tool that helps us make sense of all that.
So let's jump right in and see if we can bring a little bit of order to all that chaos. It turns out it all starts with having the right tool for the job.
And that tool is beta. The best way to think about it is like a yardstick, but instead of measuring length, it measures volatility. It tells you how much a single stock tends to move compared to the market as a whole. It's not a crystal ball, mind you, but it gives you a great sense of a stock's personality.
Okay, so we're calling it a yardstick, but what is it, really? Let's get a more precise definition so we're all on the same page.
So here's the textbook definition. It's a statistical measure of volatility. But the most important part, the phrase you really need to remember, is in comparison to the overall market. A stock's beta is completely meaningless by itself. It only makes sense when you're comparing its movement to the market's movement.
This comparison helps us sort stocks into two main camps. First, you've got your thrill seekers. These are your high beta stocks. Think of fast-growing tech companies where big news can cause huge price swings. They're more volatile, which means more risk, but they also have the potential for much higher returns. And then you have these slow and steady crew. These are low beta stocks, often in super stable industries like utilities. I mean, we all need electricity and toothpaste, right? So these companies tend to be less volatile, which means lower risk, but usually more modest returns.
So how do we actually read this thing? Well, it's actually pretty simple. It all comes down to how a number relates to one key figure, the number 1.
Okay, so if you see a stock with a beta greater than 1, that's your signal that it's expected to be more volatile than the market. For instance, a stock with a beta of 1.5 is theoretically going to move 50% more than the market. So if the market pops up 10%, that stock might jump 15%. But remember, that works on the downside too.
Or on the flip side, if a stock's beta is less than 1, it's expected to be less volatile. So a beta of, say, 0.5 suggests the stock would probably move only half as much as the market. It's a little more shielded from those huge market swings, for better or for worse.
And what if it's exactly 1? Well, that's as straightforward as it gets. It means the stock's price is expected to move pretty much in lockstep with the market. Market goes up 5%, the stock goes up 5%. It just mirrors the overall trend.
Now, I've been saying the market over and over. But what does that actually mean? It's not some abstract concept. Let's look at what benchmarks we're actually comparing these stocks to. So when we say the market, we're usually talking about a big stock index. By far, the most common one is the S&P 500. It tracks 500 of the biggest U.S. companies, so it's a fantastic gauge for the overall U.S. market. For tech stocks, a lot of people use the Nasdaq 100 as their benchmark. And yeah, you've heard of the Dow Jones, but since it only has 30 companies, it's not really used as a broad market benchmark that much anymore.
Okay, this is all interesting stuff, but here's the million-dollar question. How can you actually use this? How does knowing a stock's beta help you make real-world decisions?
Well, let's say you're an active short-term trader. For you, volatility isn't scary, it's an opportunity. You might specifically hunt for stocks with a beta over 2. Why? Because a stock like that tends to move, on average, twice as much as the S&P 500. That means more chances to get in and out and hopefully profit from those big price swings. But maybe that sounds way too stressful. If you're more of a defensive investor, you're going to do the exact opposite. You value stability and you want to keep risk to a minimum. So you'll be looking for stocks with a beta below 1. These are those slow and steady companies we talked about, the ones that are less likely to get rocked by a big market downturn. And you know what? Finding a stock's beta is super easy. You don't need any fancy software, just use a free online tool called a stock screener. Pretty much every financial website has one. You just go to the filters, find the one for beta, and then you can tell it exactly what you're looking for. Show me stocks over 2 or under 1, whatever fits your strategy. So here's the main takeaway from all this. Beta is not some complicated number just for Wall Street analysts. It's a powerful, easy-to-use lens that helps you assess risk.
And more importantly, it helps you make sure the investments you choose actually align with your personal goals and how much volatility you're comfortable with.
So I'll leave you with this little piece of homework. Think of your favorite stock, one you follow closely. Go look up its beta. Now that you know what you're looking at, what does that number tell you about its personality? What does it tell you about its place in the great, big, chaotic world of the market?